See, good afternoon, friends. It is on the very first question, chapter in question, that is on chapter number 3, security analysis. Let's just go through that. One of the easiest problems that we have. You need to have 5 minutes practice before going to the examination. Ensure that you handle this problem before going to the examination because under examination conditions, it requires quick working and we should be remembering all the points, right? Now let's just go through the closing values of NSE Nifty from 6th to 17th of the month of January of the year 2020 are as follows. Day 1 to 12 with dates they have provided 6 up to 17 and days Thursday, Friday and all that they have given Sensex values they have given and there were some days where you never had any trading at all. Then calculate exponential moving average of Sensex during the above period. The previous day exponential moving average of Sensex can be assumed as 15,000. The value of the exponent for 31 days exponential moving average EMA is 0.062, which will normally be provided in the problem. Give detailed analysis on the basis of your calculations. Now, how do we handle this particular case? See, now let me just start the discussion, not for all the 12 days that we will be having. So we will be having 1, 2, 3, 4 and 5. 5 days. 5 days we will not be having any trading at all. So it would be nice that we try it out through Excel. But I want to try manually. So Excel is the best way of doing it. But since you do, or that is you are doing under examination condition manually, I prefer to do it manually even if it takes extra amount of time. Now let's just try that. So what are the columns that we are expected to develop? So I would just say date is very important because only on trading days we will be finding out. Then actual index. Then opening, difference with signs. Then difference multiplied by exponent. Then closing EMA. So column 1, column 2, column 3, column 4, column 5 and column 6. Now let us just take up the first trading day, 6th of January. 6th of January 2020. Index on that day being 14,522. The previous day EMA is given as 15,000. Where it is provided in the problem itself. The previous day's EMA is 15,000. What is that we should do? Compare this two. So that particular day's index had fallen down when compared to 15,000. How much is the fall? 478 is the fall. Correct? Now negative 478 multiplied by the exponent which is provided in the problem 0.062. 0.062. Now let us take the calculator. 478 into 0.062. What you get is 29.64 negative. What is that we should do? This negative figure should be adjusted with opening EMA. That is 15,000 minus 29.64 plus 15,000. It comes to 14,970.36. Let us just check up as whether it has just come like that. So it is all like that. So we will just maintain our computation, and it is always good that when we do off our own, we will have better impression on the subject. 7th of January 2020, which is index, that day's index given as 14,925. 14,925. The previous day's EMA is 14,970.36. Yes, it got dropped 14,925 when you take up. It comes to 45.36 in the negative. So 45.63 multiplied by 0.062 to 0.062. The product will also be in the negative 2.81. 2.81 should be added with 14,970.36. It comes to 14,967.55. How did you get 14,970.36 minus 2.81? Correct. The next trading day is 10th January 2020. So that day's index 15,222 versus 14,967.55. So what I find is this number 15,222, where you find a positive impact only 254.45. So 254.45 multiplied by 0.062 into 0.062. How much you end up with? 15.78. Add this to the previous number. So 14,967.55 plus 15.78. 14,967.55. What you just get is 14,983.33. So the next day is 11/1/2020. It is 16,000 is what you have, and 14,983.33 is to be taken up. So a comparison has got to be made. So there is going to be a huge increase, 1016.67. 1016.67 multiplied by 0.062 into 0.062. This results in 63.03. So 14,983.33 plus 63.03 plus 14,983.33. What we get is 15,046.36. The next trading date is the next day. 16,400 is what you have. 12th of January 2020. It is 15,046.36. This I would like to compare it with 16,400, which results in positive value only 1353.64. 1353.64 multiplied by 0.062 into 0.062. I get 83.93. This I would like to add it with 15,046.36. What we end up is 15,130.29. How did I get 15,046.36 plus 83.93? So the next day is also a trading day, 13/1/2020. What is the number that I get? 17,000. There is a huge leap. That is what we are finding out. Now let us just take up 15,130.29. So this I deduct from the figure of 17,000. I end up with 1869.71. 1869.71 multiplied by 0.062. How much we end up? Let us just check up into 0.062. You end up with 115.92. This I would like to add it with the previous number, that being previous day EMA 15,130.29. I end up with 15,246.21. How did I get 15,130.29 plus 115.92. So at no point of time you should feel lazy, because at any point of time you can roll back and check up whether you are on the right track. We are very fortunate for the next 3 days, no trading. And on 17th of January 2020, the last date of the trading, here you have 18,000. Once again, it is a big leap. Now let us just find out. It is 15,246.21. So this I compare it with 18,000. So what you end up is 2,753.79. 2,753.79 multiplied by 0.062 into 0.062. You end up with 170.73. So this I will add it with the previous number 15,246.21. You end up with 15,416.94. How did you get 15,246.21 plus 170.73? That is the way you just get. So now let us just check up whether the computation had just gone in that fashion. So exactly that is the number that you end up with, 94. Okay. What is the conclusion that we would be making? Look at the conclusion. The market is bullish. So what do you mean by bullish? It is on the rise. The market is likely to remain bullish for short term to medium term if all other factors are remaining the same. So on this basis of this indicator, exponential moving average, the investor or broker or anybody for that matter, they are expected to buy, that being take long position. This is the conclusion that we are going to make. So let me tell you that this is going to be computationally a little wanting, in the sense those who find it um, prone for committing errors. I would only tell you should double check before proceeding to the next one. The reason is that when any mistake is happening in second day, that is going to have a rollover effect in other days, and accuracy is a very important factor based on which marks will be provided. So if a person is concluding as bullish but computationally going wrong, would mean only for the conclusion part they may award marks, and for computational errors they will reject. So therefore you got to be checking at each stage before going to the next stage, and computationally they are not going to, what should I say, cause any big worry. Thing is that a lot of computations are there, human errors are possible, transposition of figures might cause some trouble. So if you know as how it has to be presented, double check before going to the next step. And if you do that, you will be hitting the correct answer. All the 6 marks or 8 marks, whatever marks that they award, you will definitely be getting. And I wish that this problem is appearing in the main examination. Thank you.